Good morning. Welcome back to the Retirement Report. I'm Hank Parrott, your host. And join me is Phil Kosmala with Tabor Kosmala. Now, Phil, I'm going to probably mess this up, but you're managing partner plus, I believe, chief investment strategist. So I get that right?
That's right, Hank. You got it. Good memory.
Cool deal. Okay. And we've been talking, and this is the part I think is, with all the Ukraine-Russia, mainly because it's the big bright light right now, the big thing everybody is concerned about that's drawing everybody's attention, and the fear that it's generating and the uncertainty. But now I think you've handled, hopefully given people some perspective on that and help us, feel a little more comfortable with what's going on there. But the temporary impact that it's likely to have on the market. The Fed, on the other hand, and what's going on there, the broader economy, the inflation, again, we talked about supply chain, but in particular, the pace of Fed tightening, as you said, is still what matters most.
That's right, Hank. And I think the number one question that we're getting from our endowment and foundation clients and our big institutional clients, as well as family clients, is really simple. Historically, if the Fed starts tightening, what has that done to markets? Mm-hmm. And I think there's a reaction to say we've had zero interest rate policy. When the Fed starts tightening, the party's over. And
let's go ahead and put that slide up for you too, Phil, there on the that chart.
Yeah, so again, history is a great guide for us. And I think, back to Mark Twain, history doesn't repeat itself, but it often rhymes. I think when we look at these periods and these patterns, what you see historically is that when the Federal Reserve starts tightening rates, we know things happen. Volatility kicks up without question. But ultimately, if you can hang through it, Hank, stocks have been up every single time during the Fed tightening campaign, not just the first hike, but
let's
for the duration.
Zoom in, to your point, Phil. Let's zoom in on that right hand, those last three columns, the more recent periods there where we can maybe get and then zoom in there. There we go. So those dates that we're talking about on those last three bars back in the mid-90s and then 04 to 07, what we saw, so that 13.8, to your point, how the markets did following or during Fed tightening. So let me go ahead and have you delve into that.
Yeah, so Hank, I think when we look at this and you look at 93 to 95, that tightening cycle, the S&P gained 13.8% annualized return. So that's 38% above the long-term average of 10, which is what stocks have returned since 1900. And we saw the same thing from 04 to 06, where the stock market returned almost 12% per year during that tightening cycle. And then lastly, for October 16 to 19 through March of 19, stocks gained 15% per year during that time period. Again, volatility kicked up, but stock returns were still positive. It's, Hank, two takeaways for all of our viewers today. Number one is it's when the Fed stops that we have to worry, because that usually means that they're acknowledging that something's slowing down too much or something's breaking in financial systems. Mm-hmm. That's point number one. But point number two, Hank, if you don't mind, if we go a little bit further to the left in these columns, the example that's probably most like today would be the April 1977 to April 1980 tightening campaign. That was, think of the Iran hostage situation, double-digit inflation. Hank, that's eerily similar to what we had today, where you had geopolitical strife with Iran, and you had really high inflation, persistent inflation for a long period of time. And the S&P still produced 8% per year during that tightening campaign. Right. So I think that's probably the one that's the best.
And that's still showing an 8.2% annualized return over that period. And this is with, and in particular, when we think back, as far as I believe Carter, his presidency, the fuel prices, all the different things that you were just referring to, and the impact that in inflation through the roof, double-digit inflation, in fact, and yet the market's still chugging along pretty decently, at least. Now, there, would you say that the negative, that the 8.2 that's showing, Phil, how that compared with, is this after inflation or before inflation?
Before. That's just a nominal return, Hank.
Right.
But I think the point is that was a tough 3 years for bonds.
Exactly.
Hank, you have, I think everyone has you've got a couple of fishing ponds from an investment perspective. You've got stocks, you've got bonds, you've got insurance contracts. That was a really difficult period for bond investors and fixed income investors. equities were, despite war, but the prospect of war with Iran, and despite the really high inflation, again, Hank, that was really high inflation for 3 consecutive years.
Yep.
We just have, a temporary 8-month spike in inflation that should start to recede. So equities are a good hedge against inflation, I think, is the key takeaway from this.
Let's take a look, in fact, rates and tapering. Let's look at this next slide, the pace of hikes being critical. March 16, Federal Reserve meeting includes the summary of economic projections. So we can get that slide up. And you can talk a little bit about these the cycles that we've seen there. It's one of the things, again, I love the historical perspective. Maybe we can zoom in. I know that's a lot on the slide, but you can talk about this a little, Phil.
Yeah, and I think this is history, once again, Hank, and seeing how markets have reacted to Fed tightening cycles. And the lines we're watching, and the question that we should get some resolution to on March 16th is whether or not this is a quote-unquote slow cycle. That's the black line. Or if it's a fast cycle, meaning the orange line. I apologize. This is from Ned Davis Research, one of our research outlets, and unfortunately they picked the volunteer orange for everyone down in Tennessee as the bad color here. But those fast cycles, when the Federal Reserve is increasing interest rates by 50 basis points, 75 basis points, people forget Paul Volcker took rates from 7% to 17% to fight inflation, Hank. Yeah. And we're getting angst over a 2% raise over a 2-year time period. And so we have to keep this in mind. But if we look at, this goes back to World War II, if we look at all these tightening cycles, if the Fed tightens in a slower fashion, meaning that we get a hike at every other meeting, or we hike for the next 3 meetings and wait to see if supply chain issues are rectified, that's still our base case. Markets have returned double digits, Hank. You've had really good returns at slow tightening cycles. It's those fast tightening cycles where you see a lot more volatility. Notice how that orange line is much more jagged and volatile and flat. So you see more volatility and lower returns if it's a fast cycle. If they say we're hiking at every meeting for the next 2 years, that could be problematic for equities.
Yep. This is one of the areas. So when you're, one of the things with for people to understand, and this is, as we're reaching out and educating people a little bit, both as far as from a historical perspective and how these things actually impact the markets, to help people maybe understand, in particular when we've had a relatively smooth run now for, what is it, 12, 13 years, since 09, when when the market rather bottomed back in March of 09, and the run up that we had, with the exception, of course, of the short-lived pandemic bear, if you will, in early 20. This is one of the longest, was coming out of the longest bull market in history. But then how that looks, I think the average is still up around 15% maybe, if we looked at the last 10 years even. And what do you see going forward over the next 5 to 10 years?
Yeah, Hank, I think it's imperative when you have returns that are this far above normal, like we've seen for the last 15 years, markets have a tendency to what's called mean revert, or revert back to the average. And so stocks have returned 10% since 1926. So you're right, Hank, we've had above normal returns for the past decade. And that includes the 33% sell-off that we saw when COVID broke and we closed the global economy. But ultimately, Hank, we think, with PE multiples are relatively high, you've got higher inflation. The Fed's going to have to be more vigilant with fighting inflation and raising interest rates. That probably leads to an environment where we have lower, more normal returns, but with more choppiness. And I think investors have to be prepared for that.
And that's, talking about more choppiness. Let's show this next slide, Phil, on the rates and tapering. Because this one here, you're talking about these 10% correction. You were just talking about every 15 months, but that those may occur more frequently during tightening periods like this?
You got it, Hank. I know you're a student of the market as well, and this is one thing that we always watch is when the Fed, those are the red circles on the bottom, when the Fed starts to tighten or take liquidity away from financial markets, there's just a higher probability and you see more sporadic 10% outbreaks, Hank. So I think this is just making sure everyone watching the retirement report today knows the last decade's been really easy, Hank. It's really been a one-way ride upward. It should be more challenging. We should have more of these fits of volatility. Expect that, but that doesn't mean that you still can't have really solid returns going forward, but it won't be as smooth as it's been for the past decade.
Yeah, the more, and now and this is one of those areas when we get into, of course, talking about income again, and of course, sequence of returns risk that can maybe play into that as well. That we have to be thinking, how do we set up our income plan? And I'm going to hit one more slide, but I'll come back around to that and setting up income, because this is one of the areas I know with my clients. What we talk about is, how do we in fact make sure that we're going to have the income that we need, stable income, not impacted by the volatility, in particular when volatility is increasing. And there's some safe money alternatives we can use. Annuities we've talked about is one way to put in a foundational base as far as income goes. There are other tools that we can use as well. But I'll come back around. But first, Phil, I wanted you to comment while I still got you on this perspective on the rising Fed funds and bond yields. So if we can get that slide up as well, Marilena, that was, and have you comment on that, Phil.
Yeah, Hank, I think what do we know when the Fed does start tightening rates is it's painful. That you see volatility kick up. We know that. You see price to earnings multiples come down, and you see volatility. So that the chart on the left, Hank, is really simple. It's volatility when 2-year bond yields move up, and 2-year bond yields are the predictor of what the Federal Reserve is going to do over the next couple of years. The chart on the left shows that volatility, or this is the VIX index, which many viewers may have heard, the volatility, the implied volatility of the S&P 500. When the VIX index historically has seen bond yields moving up, you see volatility kick up as well. So I think that just coincides with our prior chart, which is that 10% corrections are more frequent when the Federal Reserve is taking liquidity out of the system. But then secondly, price to earnings multiples come down, Hank, and I think that's why you're seeing some of these technology bellwethers and high-flying stocks, some of the meme stocks that were trading at 30, 40, and 50 times forward earnings. When you see interest rates go up, unfortunately, those stocks are usually the ones that are most quickly taken to the woodshed by the market. And that's why we're seeing some of these high-flying technology stocks really get hit as interest rates are moving up. But ultimately, Hank, what matters is when the Fed inverts the yield curve. And the Fed is very cognizant of the repercussions of what's called inducing an inverted yield curve. And in layman's terms, that's when the 3-month Treasury bill offers a higher yield than a 10-year Treasury. Why is that so critical? It's preceded every single recession that we've had since World War II. And that means that the market thinks the Fed has tightened too far, and we're not even close, Hank. So I think accept more volatility, but until we actually see.
Well, I wish we had more time, Phil. I'm running out, I'm afraid, and I wanted to cover so much more with you, but we're going to have you come back here soon. In particular, I'd like to start there and do a whole show just on that. But Phil, thank you so much for joining us today, and I'll look forward to seeing you again here soon.
Sounds good. Thanks, Hank.
All right, take care. All right, we're going to have to take a quick break. Join us here. We'll be right back on the Retirement Report.
There is no